Yep.
Okay, moving on here. The U.S. and Mexico are dialing back the rhetoric with the announcement they have reached a deal to, quote, indefinitely suspend tariffs on Mexican imports. Joining us to discuss this further is Deloitte Chief Global Economist, Dr. Ira Kalish. Great to have you on today. Let's start with what exactly we know about this deal. There's certainly a lot of skeptics out there who are saying that the president essentially created a problem, solved it himself, and then when you look at the details right now, this is sort of what Mexico promised before.
Well, that is what's being reported by the New York Times and others, and the administration is denying that, and they're saying that there are some new elements to the deal. We haven't seen all the details, so it's hard to say, but I think what we do know is that the rest of the world will be watching this carefully, especially China. And if they think that the administration got nothing except the ability to claim success, that will affect their negotiating strategy with the administration. And if they think the administration actually got a major deal, then that will also affect how they approach what they do with the administration.
You know, Ira, over the last, let's call it 6 weeks, there's certainly been a change in the way that I think the market has viewed the likelihood of a U.S.-China trade resolution. When you're looking at your outlook for the global economy over the next 6 or 12 months, has that changed recently? Do you now expect things to be tougher for global growth as a result of kind of a cooled period here between the U.S. and China? Or do you still believe there's a pathway towards these trade tensions getting resolved?
Well, I mean, when the administration announced that there would be no deal with China, and they were putting the 25% tariff on the $200 billion and then threatening to add a 25% tariff to another $300 billion, my view changed, as did the view of investors. We saw a sharp drop in equity prices, a sharp drop in bond yields, and an increasing expected prediction that the Fed would loosen monetary policy. So my own view is that if all these tariffs go into effect, we'll see the U.S. having gone from 2 years ago with some of the lowest tariffs in the world to, by the end of this year, some of the highest tariffs in the world, certainly having a big negative impact on consumer spending ability, certainly increasing the cost of businesses with global supply chains and hurting the competitiveness of U.S. exports, certainly hurting U.S. exporters that will face retaliation from China. So I think this could be the difference between the U.S. having a recession and having simply a downturn. And that's why the Fed, I think, is clearly considering an easing of monetary policy. And it's not clear if such an easing would be too late.
Ira, do you think an easing, or do you think the Fed should cut rates at this point if nothing changes, if we're still at some sort of standstill when it comes September or looking ahead to December? Do you think it is time for the Fed to then cut rates?
Yeah, I think that it probably makes sense in the coming year if the administration goes through with these tariffs and if inflation remains low, which I think is likely. It probably makes sense for the Fed to cut rates because otherwise we're looking at a significantly weakening economy. Already in the first couple of months of 2019, we've seen a sizable weakening. We've seen very weak retail sales, weak industrial production, weak trade, a weak housing market. We've seen tension in the credit markets, and we've seen the potential negative effects on the U.S. economy from a severe slowing of growth in both China and Europe. So, yes, I think it does make sense, and I think it's likely at this point.
Okay, we'll have to leave the conversation there. Appreciate your time today. Dr. Ira Kalish, Chief Global Economist at Deloitte.